Hi, this is Dan Collins coming to you live from Traders Expo New York, and joining me is Jeanette Young, the options queen. Jeanette and I had been talking because we spoke many years ago when she was still trading coffee on the floor of the New York Board of Trade, and I was just a cub reporter for Futures Magazine on probably still the biggest story of my life. But you have survived the transition from the floor, and mainly because you've been an expert technical analyst. So talk about how you made that transition.
Well, I mean, first you have to understand that being a woman on the floor, you're one of 12 brokers on the floor, and you have no advantage whatsoever. You don't go to the men's room with the guys and sit there and talk about where the stops are and who's got what paper. You don't go to the bar with the guys and listen to them schmooze. So you actually have to figure it out on your own. And that's basically how I always survived. I'm an excellent technical analyst. I've been very lucky to be good at it, and I have been able to survive both on the floor and off the floor because I actually did use computer-based trading while on the floor, because I was in the Russell pit. I used to lay it off in Chicago in the S&P, and I used charts. I'm a chartist.
Well, that's very interesting, and a lot of people who were expert traders on the floor did not survive the transition, but there was an advantage that was perhaps space. You were near the broker with the largest deck. You were stronger, taller. It was a very physical presence. So you worked on the technicals, and you didn't take advantage of some of those physical things that gave those people an advantage. You worked on the numbers.
Well, that's true. That's how I actually, one of the guys actually said to me, I'm not going to trade with you, Gert, anymore, because every time I trade with you, I lose money. And I said, well, you just look at the chart. The chart tells you what to do. Don't try to tell the chart what you want it to do, because that doesn't work. It doesn't work at all. And a lot of the reason a lot of these traders lost money after leaving, and they made a lot of money. They made over $1 million for their seats when ICE came in and took over. They lost because they thought in their head that they knew what they were doing, and they had based it on inside information, and they actually didn't know how to trade.
Okay, well, you wrote a book on trading options, correct?
Correct.
And it seems to me that the complexity of options and the beauty of options is that you can make a precise trade. And is that where you had your advantage, because you did the technical work, and you weren't necessarily focused only on the most liquid front month contracts where people were kind of jammed in? You had to do spreads and you had to do options where there was a little bit more thought and math involved.
Well, as an options market maker in the Russell pit, for example, and I spent a lot of time, spent more time there than in coffee. I mean, we basically traded the front month. We did not trade further out because it didn't make a lot of sense. And as a market maker, your biggest job is to negotiate your risk and get rid of that risk. So every time you buy a position from the public, because we had to buy or sell to the public, you're automatically putting another position on to hedge it. So we hedge everything. And my father used to say to me, well, Jeanette, if you're hedging everything, how can you make money? You're just getting rid of the risk. I said, because there is enough in there to make the money. Yeah, you're not going to make the big ones, but you're going to make little ones all the time.
I would think, especially in those days when the Russell was not as liquid as it is now, and the spreads were much larger.
The spreads weren't that. We had in the pit, we had two designated market makers. We had Susquehanna, which is very aggressive, and we had another group there too. So they would take the lion's share, and they would, the spread was maybe a quarter. We wanted to keep customers. We wanted the pit not to go away. So we made huge efforts to keep it fair. And that's how we survived as long as we did. But the guys didn't understand that we were going to go electronic. I remember being in sugar, and I'm in sugar with a PDA. The exchange gave me a PDA, and the rules say you have to, every half an hour the bell rings, and you have to hand your trading cards to either a clerk or put it into the system so the other side knows that you are either taking from them or giving to them. So the trades are all straightened out. Well, I had a PDA in sugar, and they wouldn't trade with me unless I put it on a trading card. So I'd put it on the trading card, and then I'd put it in my PDA.
And that was near the end of it.
That was near the end of it. Eventually, but as a Russell trader and an S&P trader, I had to use them both together, the New York Composite, S&P, so that I could deflect some of the risk I had. I couldn't keep that risk. The contracts were way too big.
Yeah, they were big. You know, we're going to take a break right now, but we're going to come back with more stories from Jeanette Young, the Option Queens, live from the New York Traders Expo.